Well, the 10-year Treasury yield crossing 5% for the first time in 16 years now, just briefly backing off that, just hovering just under that level. Now, the move coming amid a volatile week for the markets. Retail sales, jobless claims data showing that the economy has remained resilient, while companies have also reported solid earnings so far. It was all capped with a speech from Fed Chair Jay Powell signaling that another pause in rate hikes at the coming November meeting here is likely. So what should investors do to navigate this market? Joining us now with his analysis, we want to bring in Ben Laidler. He's eToro's global market strategist. Ben, it's good to see you. Let's start with the movement that we've seen in rates. I think that's one of the huge takeaways here from the market action this week. The 10-year yield right around 5%. What does this mean for investors? How should investors be thinking about that?
The markets are caught right now in a vice between these high bond yields, which are depressing valuations, and high oil prices, which are going to be holding back the economy. And I think from here, I think both those things self-correct, meaning that these tighter financial conditions and this drag of high energy prices on the economy, I think that slows the economy. I think that will bring down underlying inflation. And therefore, I think both those things come down. And I think that will be the release of that vice, so to speak, will ultimately be a relief to markets. It may take some time to come through. But I like to paraphrase the oil market or the phrase from the oil market. I do think the solution to high bond yields is actually high bond yields, which we're having right now.
And so to what extent does it slow the economy more than we've already seen some slowing, especially in the face of resiliency that has also been present, Ben?
Yeah, I think this is the slowdown that's been delayed, but it's absolutely coming. And the tighter financial conditions get, which is what you're seeing with these higher bond yields, which is what you're seeing with the stronger dollar, which is what you're seeing with less bank lending. All this is coming, the way of the consumer. So we're going to get a third quarter GDP report next week, which is going to be a gangbusters number, 4 to 5%, a number which, frankly, we haven't seen in, up to 40 years. It's inconceivable to me that isn't as good as it's going to get for the U.S. economy. And I just think with these headwinds, beginning to pile up, the direction of travel is pretty clear. And I think that will at least put a cap in bond yields and probably oil prices as well. And if I'm right, the easing of this vice will allow markets to perform better than they have been over the last month or two.
So Ben, then I guess more specifically, what does that mean for investors? How should investors be playing this massive jump that we've seen in yields? And then also, if we do see it back off from some of these levels, how do they adjust?
Yeah, so I think you should be in stocks. I think the bigger risk is being out of stocks rather than in stocks right now. But I think within that, I really think it's a big tech story. We're going into third quarter earnings season. Big tech's going to start reporting, next week. Those Magnificent Seven are going to report 30% plus earnings growth. The other S&P 493 will basically be flat. And I think this is just going to be another indicator that I think tech is the place to be. And I think the impact of these high tech valuations of these high bond yields is now beginning to, investors have moved on. Investors are now a bit more concerned about the slowing economy, which is why cyclicals and small caps, which are very cheap, but they're more economically sensitive, are underperforming. And the things that are doing a bit better, despite these high bond yields, are things that, have these defensive earnings or can deliver growth. So I think that's tech. So be invested, be reasonably defensive, stick with these big tech names, which I think have taken the valuation hit and are now really showing off their sort of earnings growth and sort of defensiveness bona fides in this environment.
For this earnings season, Ben, we've kind of had different phases of the earnings narratives over the course of this year. What's one that you expect to prevail this earnings season? And I'll throw one out there from one of our prior guests, Liz Young from SoFi had said that cost discipline might be it. That cost discipline could show up through quiet cutting that even has been one of the more tossed around restructuring type of terms that's been brought up to date here. What do you expect to be one of the themes?
Yeah, so this is a pivotal earnings season. All the money you've made in markets this year has come from higher valuations. We need earnings to pick up that baton. And I think this is going to be the quarter we're going to start to see it. This will be the end of the earnings recession. It'll be decisively led by big tech. That 30% versus zero, earnings story. That'll be the big story, but I think there are also other stories. I think broadly we're going to be seeing less margin pressure as inflation has come down. Companies are seeing some relief to costs. They have been cost cutting, most notably big tech, and I think that's going to be part of that 30% increase in tech earnings. They were first to cut costs, and arguably they had the most to cut. And I think the weakness is going to come from commodities and cyclicals, which either did very well last year or are just going to be the sort of canaries in the coal mine, if you like, of these bits of the economy which are already slowing right now.
But when you take into account what's happening overseas right now, the threat that we're facing of an escalation amid tensions here in the Middle East, how much of that geopolitical risk do you think has been priced into the market so far?
Some, but not all. Haven assets have obviously done well, but they haven't done that well. And I think that speaks to, economic and geopolitical uncertainty is definitely up, and it's up from already high levels. And markets hate that. It saps investor confidence, it saps corporate confidence. But markets are betting that we're not going to see a dramatic escalation here, rightly or wrongly. But I would just say, this is in a context of policy uncertainty and geopolitical uncertainty, which we've learned to live with at pretty high levels. When we've come off the biggest interest rate cycle in living memory, we've had the war in Ukraine. Unfortunately, markets have learned to live with this despite all the human tragedy.